Hey traders, Stephen Quitzel here with thetradersplan.com. It's Friday, November the 3rd. Gonna do a market update. We got a lot of charts to go over. We're gonna get into some secondary indicators, some breadth indicators, and some pretty important long-term commodity charts we're gonna look at. And then of course, finish up with some individual stock ideas that might be interesting to look at. So I'm going to start with the major market indices, the Nasdaq. Let's start there. So let's just kind of go down here. Wednesday kind of rattled me a little bit, right? And I'll tell you why. It's very important. I learned this being an IBD or Investor Business Daily. You know, they always talk about it's not where the market opens, but it's where the market finishes. Okay, so I don't, that's why I typically have a rule. I'll try to buy stocks at the end of the day instead of at the beginning, because I don't know if you've ever bought a stock in the morning and by the afternoon it's looking pretty bad. So that's why I like to buy stocks at the end of the day, because if it starts strong, I want to make sure it finishes strong, even though if I have to pay just a little bit more to get that extra confirmation, I'm fine with that. So yesterday, the Nasdaq, it made an all-time high and then reversed in a really ugly way. And you can see that there's a little distribution day, so it was a distribution day. Now, the big trend is up. Don't get me wrong. This is a roaring bull market, okay? This is very 2013-ish, where every time the market pulls back 3%, you think it's going to be the big one or even an intermediate correction, and it just doesn't happen. But we're going to look at some breadth indicators that are showing the market, you know, just might want to be just a little bit cautious or have a little bit of cash. But it reversed yesterday in an ugly way. Now, Thursday, it's starting to reverse in a positive way, right? Started down and then closing in the upper end of the range. So I always want it, whether even it's up or down, I want it to close in the upper end of the range. That means there's more strength and not weakness. But you can see there's a cluster of red distribution days kind of right in this area in the Nasdaq. So it's just reason to be cautious. And just because the trend has been so strong, I'm not saying it's going to pull back to the 200-day, which is the red line. I'm just saying, you know, it could pull back to the blue line, which is the 50-day moving average, right at the 6,500 level, as it has continued to do all along the way. So if it pulls back, I believe there's your entry. And if it pulls back deeper, now we know that we're in a more intermediate correction, but you have to, you know, the trend is your friend, so you have to stick with it as long as it is working in your favor and continue to ride that. And then when the market starts to change, you need to change with it. So if we go to the S&P 500, it looks a little stronger. You can see, I mean, just kind of the same since this breakout, man, the market has just gone straight up. And the S&P 500 was up on Wednesday, but it stalled. And a stall day means it was up less than 0.2% in above average volume. That's another IBD rule. So there was a lot of volume, but it had a hard time pushing up. And you can see that it kind of finished in the middle towards the lower half of the range on Wednesday. And now there's a little bit of support in it today. So a lot of volume starting to come in here on this end of the range. It's kind of getting a little choppy versus this smooth riding. So all I'm saying is just be cautious. Just a simple pullback to the 50-day moving average is very reasonable at this point. Now, the small caps are a little different. You know, you've seen, if you've been watching these videos with me, you've seen this just big box, this rectangular pattern. The market likes to stair step its way higher. Pretty nice little bull flag, and you know it broke out, and that might have been last Friday, and then it just got slammed Monday. See, that's Tuesday, Wednesday. Okay, so then that was Friday, and then it got slammed Monday back down, and now it's just kind of falling back into the flag. Well, the flag is getting a little ugly. See this nice smooth, and then it gets a little sloppy. So I mean, I just look at it as a personality, right? When something is nice and smooth, that's good, right? Everybody likes nice and smooth relationships. Well, then when it starts to get rocky or that personality changes, you need to start paying attention. And I'm laughing because I'm referencing relationships, but you know, the stock market and individual stocks and indices, they have these personalities, and when personality changes for the better or for the worse, it's worth paying attention to. And this is just getting a little sloppy, so I'm just taking note. Nothing to really be too cautious about, but I'm trying to be very selective now with my stock picks just because I'm seeing the volatility coming in. Let's look at some breadth indicators. Now, breadth is secondary. Let me kind of repeat that. Breadth indicators, oscillators, they're all secondary. Price and volume trumps everything, okay? So if you start to see a secondary indicator deteriorate for a negative divergence, all that means is you need to pay attention, and when the price trend line breaks, then you need to take it very seriously because the secondary indicators are already weakening. Sometimes I use the secondary indicators when I see it weaken as I scale back with new positions. I don't trade as much on new positions until I see one way or the other, either the negative divergence corrects itself or the market corrects itself, either way. So I'm wanting either the price action or the breadth secondary indicators to meet somewhere. So this is the S&P 1500. This is just breadth, okay? So you have really, this is the market. S&P 1500, this line, I mean, it's just been in on a steady Freddy, right? It's a 50-day and the 200-day. Well, I have this blue horizontal line because now let's look at the S&P 500 breadth and the mid-cap breadth and the small-cap breadth. Well, this is the percentage of stocks that are above their 200-day moving average. And I use 200-day versus 20-day because I like to look at longer-term perspective sometimes because the longer-term horizon you have, you're going to have less whipsaws, right? You're going to have less negative signals the longer term you look at. So, I learned this from Arthur Hill. I kind of stole this chart from Arthur Hill. But anyway, so what this is, you got the S&P 500 breadth, the percentage of stocks above the 200-day moving average, 71%. That is still incredibly bullish, right? Anything above 60% is bullish, at least according to Arthur Hill. But you can see right here, the breadth peaked on around October 1st, okay? So you have the price action of the S&P 1500, it continued to advance and the breadth started to weaken. Now, it's not falling off a cliff or anything, but this is a negative divergence. And what this is telling me is that fewer stocks are pushing up the market. So that's the S&P 500. Okay, so then I'll look at, okay, let's look at mid-cap. Same thing. The mid-cap breadth peaked around the same time. The market is going up on fewer and fewer stocks. And then you can see the small-cap breadth. Same thing. Small cap breadth is starting to weaken. So you could say the large caps are stronger, right? It goes from 71 to 70 to 66. All still bullish, but it is slightly weakening. So it's just something to pay attention to. And you can see back here in August, the small cap breadth dipped below 60, which is an intermediate correction. Dipped below 60, it's kind of a bear market, or below 40, it's kind of a bear market scenario. And then it came right back, and we've been, on a steady Freddy trend. So I'm just showing you this just to be aware that the secondary indicators are showing some yellow flags. I wouldn't even say red flags, yellow flags, because it's still bullish. We're still in a bull market. It's important to take notice. All right, let me get a drink, and I'm going to show you a chart. It took me a while to build. So I hope you enjoy it. Okay, I have a lot going on here. All right, so let's focus. So this top pane, this is the S&P 500 relative ratio to the CRB, which is the commodity index. This is starting in 1990, and this is a relative ratio. So what this means is when the line is going up, it means S&P 500 are outperforming commodities. Doesn't mean commodities are going down and the S&P 500 is going up. It just means the S&P 500 is going up more. So it just means it's outperforming. Okay? So the S&P 500 versus commodities. Okay? So when the line's going up, S&P is winning. When the line is going down, it means commodities are outperforming. So if we go back to 1990, if you go back to 1990 to 99, you can see the lines going up. Okay? So the S&P 500 returned 266%, and the CRB returned negative 19. So that is, a 285% difference. So it's important to pay attention to relative ratios, because if you just would have looked at this simple line, you would have seen, hey, okay, I probably need to avoid commodities or at least be overweight stocks. Okay? Then something happened and we had a switch. From 99 to 2011, commodities outperformed the market. You can see from now, we all know the market topped in 2000, but you can see that the CRB returned 69% during these 11 years or 12 years, almost 12 years. And the S&P, oh, I misspelled S&P, it's supposed to be a and sign. S&P returned negative 8%. So during a 12-year period, the CRB returned 69% and the S&P 500 returned negative 8%. Now, so I drew this downtrend line, and how you want to play these relative ratios is when the downtrend line breaks, it is time to switch to the other industry. Or at least you need to pay attention. That's what I do. I just make the switch because you want to be in the stronger sector. Now, from 2011 to present, you can see that the S&P 500 has returned 105% versus commodities have negative 51%. So that is a 146% differential. Okay? So, relative ratio charts matter. And why I'm showing you this is because we're going to look at some other things and then we're going to come back. So I'm going to spend some time on this chart. This is very, very important from a long-term strategy. This is a monthly chart. Why I'm showing you this is because now let's look at S&P 500 versus the world stocks. So when commodities, I'm going to show you how all these intermarket relationships take place. So when commodities are strong, usually means the dollar is weak. And when commodities are strong, it usually means world stocks outperform the US. So you can see commodities are strong during this period, and there was no ETF or mutual fund for world stocks, so I had to start in 2002. So commodities are basically directly correlated with the price of commodities versus the performance of the world stocks, at least from a relative speaking. So you can see S&P versus world stocks, while the commodities were outperforming, the world stocks outperformed the S&P 500. So from 2002 to 2011, the world stocks outperformed 26% versus the S&P 500 over starting 2002 was 4%. Now, if we use this break, then the trend line broke, right? And then the U.S. outperforms again right here. So the U.S. outperforms commodities. It means probably the U.S. is out going to perform the world. So the trend line broke, and at the same time, the S&P 500 outperformed world stocks 105%, 63%. So it's very important to see these historical shifts, right? To know where you really want to be overweight, maybe some long-term money. So, and then let's go look at the dollar, because the dollar is really what's moving all this. The dollar and commodities have an inverse relationship. So when the dollar is up, typically commodities will go down, which will also boost the outperformance or the underperformance in world stocks and outperformance in US stocks. So you can see right here. So for the most part, the dollar is up in this pane, and you can see that the S&P 500 significantly outperformed up here. And for the most part, it's not an exact science, but the dollar is down in this pane. The commodities outperformed the US, and the world stocks outperformed the US. And now the dollar, for the most part, is back up, right, in this third pane. So the dollar is up, and that makes the US is going to outperform commodities, and the US is going to outperform world stocks. Okay. And you can also see gold down here. Gold and dollar have an inverse relationship. So when you can see the dollar goes down, gold, this is just the price of gold. I mean, just soared, right? Dollar goes down, it's got an inverse relationship with commodities, meaning gold. Okay, and you can see right here, then the dollar goes up and gold goes down. So why am I telling you this? Well, this trend line, and I've shown some of this to you before, this trend line, the S&P 500 versus the world stocks, has broken, meaning we could get another shift. So picture there's a fourth pane over here. We could get another shift in where commodities and world stocks outperform the US market over a significant period of time. Now, based on these two time periods right here, you're going to look at about an average of 3 to 4% per year in outperformance of world stocks versus the S&P or the S&P outperformance. So either or, you're looking at an outperformance about 3 to 4% per year. Well, when you compound that over 10 to 20 years, that's very significant. So when this trend line broke, it means now world stocks are starting to outperform the US stocks, okay? Now let's look at the dollar. That should mean the dollar should be starting to break. Well, the dollar made a lower low over here. So even though it's up, it made a lower low. So that confirms that a weak dollar means strong world stocks, okay? And then that a weak dollar should mean strong gold. And you can see this chart peaks in 2011. There is a breakout in gold. Now, gold on the daily and weekly chart looks kind of weak, okay? So this is a very, very long-term chart. But gold on a very long-term chart did break out of a downtrend, which means while the dollar did make a lower low, meaning world stocks did break the downtrend, okay? So you can see how they're all related, right, on a long-term chart. Now, what about this sucker right here? Let me kind of show you something. I'm just going to put a regression, okay? So let's just look at this for a second. Okay, so this really draws it for me. It takes the average price and, well, anyways, it's really easy to make a channel. Okay, so this is the commodities, S&P versus commodities. It's been roaring higher, right? Here, let me kind of move this out of the way down here so you can see this. So it's been roaring higher. Well, towards the top, commodities are kind of starting to maybe going to come down and test this trend line. This is a monthly chart, so it could take a year to get down here. But my point is, if it comes down and it breaks this trend line, that would triple confirm that the world stocks are outperforming US, that, you know, this could be a good long-term entry for gold, and that the dollar is weak. So I'm paying attention to this significantly. So my point is, we are in a raging bull market. And I think we're in, you know, the middle of a 15-year bull market, okay? But in secular bull markets, you have cyclical bear markets. So towards the end of a business cycle, typically, historically, commodities outperform. So what I'm really trying to say is, if you can learn anything from the S&P versus commodities, like even if S&P 500 goes on a 2-3 year period where it's not doing very well, or, you know, underperforming the historical 8% average, it's probably likely that commodities, you know, oil, gold, nat gas, just things of that nature, grains, are going to significantly outperform, okay? So let me delete this. So really what we're looking for, if this, let me delete that. If this starts to curl over, that would confirm everything right here, all these other pains simultaneously, because this is already broke, world stocks, the dollar's already made a lower low, and gold has already broke out, mini breakout, okay? The dollar's trying to rally. So again, this is a monthly chart. Now, I just tell you what I've done. I do have some long-term, very long-term money, and I just simply rotate between world and US, and that's in my wife's IRA. I have already moved her S&P 500 ETF into a world, all world ex-US ETF because of this break. And if history tells us anything, at least these last two examples, it could potentially represent a 3 to 4 outperformance percent per year outperformance over, you know, a significant period of time, which could significantly help my wife's IRA. So I'm just showing you this to show you how all intermarkets, they really relate, and how a lot of things are starting to break to create a new chapter or new leadership for world stocks to take the center stage, for gold to potentially take the center stage, and commodities to potentially outperform for a little while. Again, a lot has to happen, but I'm keeping my eye on this, and that's why I'm looking at commodities constantly right now to see what kind of evidence can I find that can prove this case It's really already proven in the world stocks. It's already proven in the dollar, and it's already showing up on the gold monthly chart. Okay, so I know that was a lot, but I really needed to prove that point. So in the commodity spirit, let's go look at some oil stuff. No, excuse me, that's my phone. Okay, so this is XES, the ETF, the oil and gas equipment. This is, a pretty juiced ETF. So in this top pane, you see WTIC, that is West Texas Intermediate. You got the head and shoulders. I showed this chart last week. It broke out of a downtrend, right, around 49, came back, tested that 49 support level right here, and is now looking pretty strong, trying to close above 55 to take out, when was that? The 2017 take out the late 2016, 2017 highs. Might pull back and then take another stab at it, but I would say that oil is looking bullish right now. Now, this is a really significant downtrend in the ETF, but specifically last Friday, I showed you, I had this retracement on here, and I showed you that, look, and last Friday, I'm going to inspect it, just to kind of, last Friday was this day on October 26th, and I said, hey, look at this, we're right at the 61% retracement level of this move. If it's going to reverse somewhere, it's going to reverse probably right here. And then, of course, it did. We made a little bit of money in oil, and we already took some profits yesterday, which is looking like it was a good idea. But this is looking, this is confirming potential pullback to a key retracement and strength in oil. So I'm not saying it's going to go straight up. I'm not saying this level is going to hold. I'm just saying like it bounced just like we thought it would, based on this strong move, this pullback to retracement, and now it's headed higher. So I also mentioned, let me take that inspect off because it drives me nuts, why I like the double, this is RSI 5, the double oversold bounces, okay? And why that, sometimes I love the shakeout. So talk about buy the shakeout. So you have some people that just buy when something goes below an RSI, and on RSI 5 when something goes below 30 and comes out, right? I like to buy the second one. I like to wait for that shakeout and then buy the second one. So you have a lot of people were buying right here, just completely shook everybody out. Then you have the second one. That one's a charm. Look, our subscribers at the Traders Plan, we bought this right here and made a lot of money on this move. Same thing with this too. You had an initial thrust below 30, came right back out, took that double dip, and then it came back above 30, and look at that. It was the winner. Now I'm showing you that to explain to you that anticipate the shakeout, okay? The market just has a way of just really trying to frustrate the heck out of everybody and shaking people out. So it's not so cookie cutter, but that's why I really like buying shakeouts. I really like buying stocks that have failed to break out 2 or 3 times because everyone is just wore out and doesn't want to have anything to do with the stocks. And then the institutions push it, to a 52-week high. So that's my little lesson on the double shakeout, the double oversold. So when I say double oversold in emails and in videos, that's what I'm talking about. Buy the double oversold, not here, not here. Buy it right here, buy it right here. Now that's assuming, you have conviction, okay? So I'm not saying go do that with anything you find, assuming you have conviction. So let's go look at some sector summaries, okay? Let's just, I don't really know what I'm looking for. Let's just go start looking. So these are the 9 sectors in the overall market. This is according to stock charts. So let's look what's strong on a 3-month basis: technology, materials, financials. Okay, you got staples are the weakest sector right now. Maybe it's because the yields are starting to move up, which would push some of these dividend paying stocks not looking so attractive. But that's kind of my theory. But either way, it doesn't matter. You don't want to focus on the bottom 3. Okay. And so that was the 3-month. Now let's look at the 1-month. Technology, utilities, financials. So technology and financials are also in on the 1-month. Let's look at the 1 week. Why not? technology, energy. Okay, so you're seeing a lot of different things. I continue to, and this is my personal bias. Obviously, technology won, right? But then I go look at the individual technology charts, and technology has just smoked everything, hands down. Why I'm not so intrigued with technology is because when I look at individual stocks, most of them have already quadrupled. It is really hard to find a lot of good technology stocks that are still early in their move because the bull market started in February of 2016. The market's been so strong. I mean, these stocks, they're long gone. And I look for investments that are really early in their move, and that gives me the greatest likelihood of success, at least the way I trade. So right now, I mean, if I could really point you to anything, it'd be the same thing I've been talking about for several months, and that would be focus on energy and focus on financials. Just because, the yields are starting to pop in financials, right? And banks are looking strong. Let's just look at this XLF for a second. Let me see if I can pull up the weekly chart. Okay, that's not really what I wanted. Where is, give me just a second. Let me pull up a bank stock here. You can see I got a lot. ITBX. Okay. So let's just look, or let's look at this one. Yeah, so a lot of the bank stocks look the same, okay? So, and this is why I kind of like financials right now, because like you had a major move, and you've heard me talk about, buy the failed breakouts, buy the consolidations work. So then you have, this one was really tight, and then you have a consolidation after the stock's already made a major move, broke out, and it failed. And then it just went back into a deep consolidation. This is what a lot of banks look like. However, look at the bottom of these charts, and a lot of the banks look like this. On this right side of this consolidation, you're seeing a lot of accumulation. At the same time, you're seeing treasury yields go up, which is going to help bank stocks and financials and broker-dealers and all that good stuff. So I'm seeing this. I can't just say, okay, the sector is strong. Then I go into the individual stocks and say, okay, what are the charts looking like? So when you have multiple failed breakouts in a lot of the bank stocks, and then you start to have a lot of accumulation right here, just like right here. See all this accumulation right here? If you try to break out right here, failed breakout, fell into another consolidation, and then boom. So you got this over here, and it's still deep in consolidation. A lot of bank stocks are looking like this. So it's important to take notice. And same thing with the energy. If we go over to XLE, so again, I'm looking for stuff that I think is early in its move, which is why I'm kind of avoiding technologies, because everything's extended. You have this long breakout of this downtrend. You got its first move up, pull back to the retracement zone, and then you got your first consolidation and potential breakout right there. So if that's the weekly chart, so if we go to the daily chart, see, you got this long breakout. I mean, this just wore everybody out who tried to pick a bottom in energy. And then you have a breakout, right? You better take it seriously. And then the first pull back, there's your reversal zone right there. And then, it's trying to break out. It's trying to turn around. So energy is looking interesting. Financials are looking interesting just because institutions are looking for a place to park their money that aren't as expensive. A lot of the institutions, they do look at valuations. I don't look at valuations. It doesn't matter to me. I look at price action. But a lot of institutions do when they look at, the PE ratios and all that. So they're looking for stocks to rebalance, take profits from the stronger sectors, move some money over to the weaker sectors that they think could potentially, make a second half of the year move. And I think that's energy and financials, just based on the fact technology is so strong. Like, I just can't find many technology stocks that I feel comfortable investing in, just because, they're, and maybe I'm wrong. Maybe I am. But let's look at some individual Let's look at some individual stocks. You got Jagged Peak, which is probably my favorite right now. You have, this is the daily chart, triple digit earnings here. Let's go to the weekly chart for a second. You got triple digit earnings. Look at that, 5 straight quarters. Triple digit sales, 5 straight quarters. Look at the weekly accumulation on the chart. And then boom, it broke out yesterday. I'm a little gun shy, at least I am today, based on the reversal that happened on Wednesday. So I'm trying to see what the market does for a couple of days, see if it can grab its footing before I'm loading up. I still do have some energy positions, but it's really where I'm looking. I sent this out on Monday. Cabot Oil and Gas, I sent this out on Monday as a potential reversal. Look at that accumulation. This is a daily chart. Again, look at all these failed breakouts. Failed breakout, failed breakout. Third one's a charm? I think so. Accumulation right here, accumulation right here. Weekly upside reversal, bottoming pattern, breakout. Textbook. Look at the turnaround. From negative sales to 5 straight quarters of positive, 4 straight quarters of triple digit. What's not to like? I've been big into the Chinese stuff lately, just because of how hot they are and they're moving, but I'm trying to be careful with it. Now, this is QUEB, the ETF. This is really the proxy. I'm interested to see how it plays right here. Now, this is just a benchmark to see how probably most of the Chinese stocks are going to handle, but if it breaks, I'm probably going to try to avoid some Chinese stocks because this just ETF has been so strong from 34 to 60. It's almost doubled this year for an ETF, just a basket of stocks. It's pretty strong. And when it starts to get weak, it starts to underperform. Then you look at a lot of the individual Chinese stocks and see how weak they are. So this is just something I'm paying attention to. You know, I've sent out this stock, HEBT. It's normally not my cup of tea, something that's $3. But there's just a lot going on. You have weekly upside reversal right here. And then you have a weekly upside reversal right here. And weekly upside reversal, which looks like it's going to finish this week. But if you notice, you got 3 weekly upside reversals. But if you notice, the original pattern has never failed because nothing ever undercut it. And this is going back a few months. So, you know, the way I see it, this could be a potential springboard, you know, just waiting to pop, but it's got to break out of the downtrend, you know, because you can see it tried to, and then it just kind of reversed lower, but it's still holding. It's still holding, so I'm just really keeping my eye on it, but this is a wild one. So, you know, to each his own if you decide to go that route. You know, this is just something interesting if you're a dividend investor, CubeSmart. Now, REITs aren't really the strongest group right now, but is in a downtrend for a long time. This is the weekly chart. You can see the monster move it made from 10 to 30, had to pull back and consolidate, and you can see it broke out of the downtrend, consolidated above, not only consolidated above the downtrend, but consolidated above the 40-week, the 10-week, and then broke out to new highs. So, this CubeSmart, this REIT is looking pretty strong, and from a technically speaking, I mean, if you're a dividend guy and you want to park your money in a REIT somewhere, this is looking like a turnaround stock and is looking like a really good entry. Maybe you see if it pulls back a few points, but pretty interesting stuff right there. GPK. Okay. Again, look at this right here. This is the paper and products industry isn't what I would call sexy, but you got a high return on equity. Really not really that great fundamentals, but maybe the street knows something I don't because the earnings are expected to pick back up in 2018. After this monster move from 2011 to 2015, this has been in a 3-year consolidation. Have you ever heard the term, the longer the base, the higher in space? I mean, this is my kind of stock right here. Now, I don't know if I have the patience to see this move out, but look, this has been consolidating for 3 freaking years, wearing everybody out, and now all of a sudden it broke it broke to an all-time high out of a 3-week consolidation. Extremely tight price action. Very, very solid accumulation. Everything looks right. I mean, everything looks right, technically speaking, for this to be a decent longer-term hold. Now, I gotta admit, I'm a little obsessed about a play like India. For some of these emerging markets that have extreme GDP percentage growth, like the 5 to 8% range, that have a young population of millennials, okay? That means they're not bogged down by legacy, social securities and aging population. So you have, the kinds of investments we can access, like a Pakistan ETF, India, and Vietnam. You have these countries that I'm waiting on. Now, Vietnam is looking like it's starting to take off in a big way, so I'm going to look for an oversold bounce on this one. But I'm just kind of trying to tell you why I'm showing you this. India, Pakistan, Vietnam, you have these countries that have tremendous growth that will triple the U.S., that do not have aging population problems. So there is a lot of upside potential for, a 10 to 20 year bull run, the kind of bull runs that'll probably smoke the U.S. market just because of the growth. So I'm paying attention to this. 2 more stocks. Whoops, not GoPro. This is why GoPro. This is why I don't buy growth stocks before earnings. Like, I made some money in GoPro, it gapped up, made some money, sold, and then it pulled back to the 200-day moving average, right? It's right on support. If you like GoPro, it's sitting on the 200-day moving average, but it's gapping down Thursday, 12% on earnings. So it probably needs some more time to work through that. Now, you can see 4 straight quarters of sales growth, big earnings growth in 2018, but there's distribution on the weekly chart, right? There was accumulation while it was going up. Now there's distribution. I'd be interested to see if it curls around, if it starts to get accumulation again. Something I'm looking at. Last but not least, Trivago. Man, you talk about just getting taken out to the woodshed. You got Trivago, IPO'd at 11. I'm sure we've all seen the commercials. It's a hotel booking travel website. I mean, it was a Wall Street darling. Went from 11 to 24, so it more than doubled. Got slammed right here, got slammed right here, got slammed right here, and got slammed again. Well, I've been waiting to see if there is a signal because there is value in this stock. The sales are growing, but the problem is when you're a growth stock and you are you're selling at high growth valuations, you better grow at those valuations. And if you don't, you're going to get your butt kicked. And that's exactly what happened to Trivago. So in my opinion, kind of almost serves them right for coming out at just an astronomical valuation. But anyways, now it's popping 16% on above average volume. Man, is there some value down here? I don't know. I don't know if I'll get involved in it. I might wait for a consolidation, that first consolidation breakout, to see if I can get that. But I was considering it right here, but I was going to wait. I had to wait for a breakout, so I had to wait for this to break out, and it broke down instead. So I just avoided it, and now it's coming back around, and there's a first sign of major accumulation. So just paying attention to it.